Welcome all to one more session of Trend Talks with Dharmesh. Dharmesh, good to have you here as always. It's been a topsy-turvy kind of climate in the markets. Earnings, like expectations, didn't really work the way they are supposed to work. So, we quickly wanted to have your views on that.
Hi, good to have you all back again. Earnings definitely was weaker this time around, and this was on the expected lines because expectation was on a single digit kind of earnings growth across the board, which came through. Nonetheless, the environment and the context in which the earnings were reported weak were not very conducive. The reason being it was across the board kind of a washout for the earnings perspective, and specifically from the BFSI and banking space where asset quality deteriorated further. At the same time, credit cost went up, slippages were higher, which is basically a general barometer of the entire economy. And the management guidance which came through was one more quarter of pain. It was second half which they expected things would improve. And this has to be seen in the backdrop of this is happening when interest rate cycles are on a downward trajectory. There has been a consistent rate cut. At the same time, direct tax benefit which was rolled out by the government was already into play, and expectation of a better monsoon. So things were looking murkier, and to top it up, the US Trump tariff policies made it a life difficult. Earlier, the sense was that the US will go soft on India, particularly with China plus one kind of an environment. But they have taken a hardline stand, and this time around, while the rest of the world is levied 15% kind of a blanket tariff, India has been imposed 25% to begin with. An additional 25% may come through if Russian oil sanction continues to be in place. That we will see on 27th what the final outcome is. My sense is it's not going to hold out to 50% kind of an environment. Definitely, it will be negotiated further. But both the sides have taken a strong stand. The US wants to negotiate on two counts. One is the farm produce, and the other is the Russian oil thing, where they want to weaken Russia. India is vulnerable to both the segments because one is you are getting a cheap oil import, which you need. 80% is imported into India, and the second is a farm produce, which is very populist, and still 40% of the population is living on the farm side. So that's a delicate position to be in when things are unsettling. Sridhar, if you look at it from the entire perspective, it may sound very small, the amount which is involved in the listed space, like 3% of the GDP or Nifty 50 earnings. Some calculations suggest 10% of the revenue comes from exporting to US and all. But eventually, what happens is it has a mass impact on the MSME segment. So there are many small scale, mid scale companies, industries which are catering to US either directly or indirectly, and they are the largest trading partner. So it will be a difficult spot for the market. And as it appears, if this continues for 2 or 3 months more, then this entire FY26 will be washed out on the earning front. The only worry is the cascading impact of the earning, how this can multiply, how it can further lead to unemployment or further government support. Things are looking very, very difficult. Government is doing all its bit. First, they came up with direct tax cut, interest rate cut. Now they are proposing an indirect tax cut. So this will definitely add to the fiscal maths. So around 40 to 50 basis point as of now looks likely to be a hit on the government the fiscal revenue which they earn through it. And the thing is, they are saying volumes will take care of the loss in the percentage term, which looks unlikely because you can earn money while trading with the globe. As far as domestic consumption is concerned, we have seen the trend for last 4 or 5 quarters. It has not been happening. Domestic consumption, it is getting plateaued at a certain point, and I mean 5-6% kind of a growth will be there. That's a natural growth given the type of population we are sitting on. But to trade further, the idea in the theory was China plus one will play in favor of India. And even 5-7% kind of a China global trade comes to India, it is good enough for 1.5 to 2 trillion kind of a boost up. So that all has come into question mark, and fairly valued market at current juncture. So upside and downside both looks restrictive. Why I say downside is restricted after speaking so long on the negative trajectory is there's a ratio called bond yield to earning yield. So usually what happens, the equity risk premium gets adjusted with what kind of a bond yield you are getting from the market. So even bond yield is falling, So in a scenario when even bond yields are coming down because of the interest rate cut, so your asking rate for equity earnings growth comes down. And
Right.
as of now, it is around 1.25, 1 year forward bond to equity yield. So that is almost 10% lower than 10-year historical mean of 1.34, 1.35. So that provides the necessary cushion to the market. There are many funds which just replicate indexes.
Right.
So there the value is there. In the Indian equity market is not that expensive. If you look at PE multiple, it does look expensive because run rate of earnings growth is slowing down. At 8-9% growth, 21 times, 22 times PE multiple looks expensive. But the real metric to look at current juncture is that 8-9% growth is what the market is expecting.
Correct.
And through that has been priced in the bond to equity yield. So there the comfort is. Likely a lackluster market which we see at least for till this things get sorted out.
One more thing that you spoke about, which we were all watching out, was the monsoons. Monsoon seems to have played out, and fortunately, this time the distribution also has been pretty decent. Is that going to bring in some kind of happiness to the markets?
The contrary, I have other take on this because this time monsoons have played out well, definitely, and it has not been that menacing. So
As
while
earlier,
the
yeah.
bottlenecks came into play, so this time the supply has been fairly decent supply and distribution. What that has done is that has led down to the earnings yield of the farmers. Usually in the monsoon season, you used to get around 50%, 100%, or 200-300% kind of hike in the vegetable prices and the farmer produce because there was a spoilage. So I mean to break it down in a very simple terms, if a farmer is producing say 10 kg of potato and selling at rupees 10 rupees, so 100 is the entire yield which he gets. If because of all this supply chains
Issues.
getting disrupted, he is losing 2 kg,
To
but the
spoilage.
price goes up to 40 rupees. So on 8 kg, he's getting a 40 around to 40 rupees kind of a
So yield is right.
produce, right? So that used to, I mean, used to be a big advantage and it used to be a bumper season for farmers actually. Most of the farming communities, some do get affected, but the people who used to escape this problem, they used to earn a windfall kind of a income, and that usually translates into festive season buying by them. This time around, we have a food deflation. So last 2 months you have a negative earnings on the food growth. So in fact their disposable income has come down because of the fall in prices and the produce being there to cater to the market. Grains, pulses, everything you have surplus storage in India. Government is already burdened with that. They have opened up rice exports completely without any restriction. All this because the supply has been fairly decent. Festive produce, and this is where the per capita income used to get boosted. So just lowering the interest rates won't suffice much, or even the GST rate, to my mind, because end of the day, it's a rate on the final price you're paying. So if you're buying a bike for say rupees 1 lakh of bike, and that interest rate comes from at 10%, 10,000. So now your price is 90,000, but 90,000 you have to shell out still to purchase a bike. So I mean, French seaters, it can still be a catalyst who was decided, but that willingness was there. So there, it can be a more effective decision can take place. But here, the entire character and the nature of income distribution is getting resetted, and that I think will play a big time on the entire consumption themes. All the Nestle's, HULs of the world will see pressure going into the festive season this time around.
Okay, but what we've traditionally seen is that the festive season is the harbinger of earnings for most of the organizations. It spurs consumption in whatever fashion it does, however small, however big, but there is a spur in consumption that happens. Now, if you couple it with the GST cut that they're planning to bring in, and they're tying it up with the festive season, I think it is going to come during the Dasera times. Is that going to be a spur in or a lead to spur in consumption?
This entire mathematics, I think, somewhere has gone wrong by the government, because one thing is either you should have rolled out the GST cut immediately. I mean, in next 5 days, so take care of your Navaratri season and the Diwali, both festivities coming in. People would have gone ahead with their purchases. Normally, there is definitely, as you have rightly pointed out, there's a spur and the harbinger of the earnings season. But what happened is they have announced that, and there's some major tax cuts and reform which the government has announced. So 20% or 15% or 10%, if you're saving on your major expenditure in excess of 7 lakh rupees and onwards, you will definitely delay that purchase till it actually is there in black and white and to have the entire benefit coming into play. So again, we don't know the timelines. As per PM's announcement, it should be by Diwali. Recent, which I have gathered from the sources, is that it is getting rushed, and likely it should be in the last week of September, so that at least Navratri and onwards things
That's
can
what
be
I heard.
taken care of. So if that is the season, then again Q2 is again, because things were getting, pickup was there in the month of July. If you look at automobiles number, there was a decent growth like Hero MotoCorp, which is an entry level bike segment provider. 21% sales jump was there in the month of July itself. Prior to that, they had a negative 10% kind of a degrowth. So things were shaping up, but again, just because of this announcement came, there may be some delay.
There could be postponement of purchases.
Yeah, and then see again, Shida, there are two catch out there. They are, getting away with two slabs and coming up with 5 and 18%, right? The general perception of the market is everything will come down to 5. It may not be the eventual rollout. There can be some items which may shift from 12 to 18. So in that scenario, because government has to take care of its,
It has its own
income.
balance sheet to
Yeah,
take care of,
so somebody has to bear the cost of this entire financing. So that one has to see, and then the 40% bracket, which they have said a special rate, rather than mentioning it as a sin good. But what are the items which goes there, how it goes there. So those caveats will definitely be at play. So let's see how it comes through. But to my mind, when things were just starting to pick up, again there has been a postponement of economic activity. So not a great situation to be in right now.
Q1, as we've already discussed, has been as per expectations. At least with our discussions, it was very clear that we didn't expect too much of earnings to come through anyways. The expectation also, like we discussed last time, was that starting second half of the year, you might see some uptick in earnings. Q2 might also be tepid, not really as bad as the last one, but it might be the one that is going to bring a lot of hope to people. How do you see that playing out now? Do you still hold that to be true, or you think even Q3 could be a little dicey?
Yeah. So first on Q2, I mean last year Q2 was the worst. So there's a favorable base effect which was likely to play out in Q2. But because of this GST announcement on 15th of August, I mean half of Q2 is likely to be a bit not that great as the expectation were. End of the day, direct tax benefits were being rolled out, interest rate cut was there, inflation was low. So there's some section of the society which could have, went into the consumption mode in an aggressive way. So that aggression, I definitely will be controlled in Q2. So Q2 again will go flat. So we are not expecting a great Q2 as well. Q3 onwards, definitely, if everything falls into place. So domestic related slowdown which was there, that catch up pent up demand will be there. So Q3 should be better on. At the same time, Shida, what happens is right now we are looking into the thick and thin of the things. But eventually, after a year when it goes by, you look on the absolute reported numbers. So this time around, there were too many exceptional items being reported. If you look at that, then the Nifty 50 earnings was 11.5%, not 5 or 6%. Like Reliance Industries sold their stake in Asian Paint. So 9,000 odd crores came through that.
Correct.
SDFC Bank had an SDFC financial IPO coming into play. So these things around 26,000 crores was added into P&L, which people have actually segregated. And after segregation, we are reporting on a pro forma PAT basis that 5-6% growth is there. Eventually, when we look at bond to equity yield and all, there you don't do all this kind of analysis.
Right.
There you go with the reported earnings. So that will look better off. So definitely there will be an environment when suddenly valuations will look damn cheap, earnings will look very cheap, and then you can have a thrust playing into the market. And if it coincides with some settlement with US and some sort of a midpoint being reached, then it can lead to a great traction in the market. Just to give you a number point of view, had it things being normal, this 25-50% tariff overhang would not have been there. It's just that economic slowdown and the consolidation phase would have been there. Then based on simple that mean ratio of 1.35 bond to equity yield, Nifty should have been at 27,000 right now. So that's the question we are sitting on. 10% kind of an upside can easily play out any given point of day in the index. Certain, positive news flows should come through only.
So all is not bad. You still look at a 10% kind of runway from here for the Nifty. Not that it's a great number, but still it's a very, very encouraging number. And this is what numbers are talking to you about. Having said that, globally things are shaky. I mean, you very clearly said the tariff overhang that we have. And obviously, while the markets will factor some of it, all of it cannot be factored because you really don't know what it is going to be. And that clarity is going to emerge only whenever 27th is what he says, but whenever he says, you really can't trust what date he will talk about. So, assuming that thing plays in India's favor, assuming, right? Let's hope for the sake of goodness that Trump continues to think that India needs to be supported and he does not actually blackmail us on Russian oil. If that falls in place, do you think market has already factored this in or will it react on the positive side?
See, market is given to excesses, but let's not forget that what market has not factored to my mind is we are still paying a tariff.
That is true.
So earlier it was 3-4% kind of a rate, which has actually gone to 25. Even if it is 15, assuming that we come to the base rate of how the Europe and others are paying, then also you have 78% additional tariff to pay. What has happened right now is stocking has happened in US. You must have heard a lot of Apple shipments and everything going. So that will also play out next 2-3 quarters even after this settlement happens. Because now they will, since 25% has kicked in, they won't be taking that stocking thing from India. Maybe need-based kind of
Correct.
orders will come through. So that has not been actually discounted by the market. Everybody is trying to do their Excel maths. It's on Excel and still, people are trying to understand. So a lot of businesses whom I interact with, promoters and all, none of them I found to be very clear on this point because there are so many interlinkages in between. People are not very clear how things are going to shape up. One thing which was clear when with our interaction with the management was US is not forthcoming. People out there, they are not discussing or disclosing or anything giving you any indication of how to go about things. The only clarity is that if you want to do business with us, you should have a presence here as a manufacturing unit. So most of the businesses are thinking either to have their establishment in US or to find out a neutral venue or country route where they will, set up the establishment and supply to US. I don't think there will be any rollback on that count.
Okay.
So if it is there, then definitely 1.5 to 2 years is lost to get the entire process in place. So that's a good time in the equity market, and that kind of a slowdown has not been discounted in the price. Time wise, we are discounting it because last year September was when Nifty made a high of 26,000, and we are now almost about to enter the month of September, still down around 70% from those peak levels. So time wise correction has happened, maybe 3-4 months more. But yes, if the clarity emerges on this and you have your maths in place, then this valuation thing which you are talking about will be formally in black and white. Right now it's still very tentative.
So you think the government will continue to intervene? See, all said and done, the retail investor still seems to be very, very gung ho about the market. You see the inflows that are coming in the fashion that they are. While liquidity is ensuring that the markets don't really go down, do you think there will be a time when there will be a pause?
That's the worst fear. I mean, that's the worst scenario you are hinting to, because retail investors don't understand the businesses. And it's the serious people who understand the business, they have not been the buyers in this market for almost 1 year now. And Shida, again, look at it. Promoters are selling.
Yes, absolutely. Absolutely.
The people who are running the business, who is doing, people are jumping on the businesses. They themselves are not very confident about the future trajectory, and wherever they can secure either their family wealth or future wealth or generational wealth, whatever name you give it, but they are securing that in a big fashion. Almost 3.5 to 4 percentage point of our promoter shareholding all put together, excluding the government of India part, has come down. Same has been the case with FIA holdings. So FIIs who were invested into the companies, either as a promoter or as a major stakeholders, they also trimming down their positions. What has been there is retail, either through DIIs, that is the mutual fund route, or directly. So they don't understand the market. Only thing is, we all can hope and pray that some bailout happens, and this has been taken care of. There is no major kind of a pain out there. So I think liquidity will improve only when the business themselves look suitable and conducive. Going by the present state of affairs, let's be very honest and candid about it. It looks unlikely. I mean, 1.5 to 2 years will be a struggle.
And we've seen that FIIs have been regularly going out of the country, right? They will have an India allocation at some level to be maintained. You think there could be some coming back of that money just to maintain their ratios?
Yeah, depends upon how the blow plays out, how the equation plays out. See, India allocation is again, the allocation is a subject of the market capitalization and the earnings growth trajectory.
Correct.
That is how the weightages realign themselves. So right now, if that premium is going out, so the weightage itself will come. So India allocation will recalibrate to whatever is the weightage and growth outlook at that point of time. The other factor, which is again like how pointed out to dealing with China, Russia, and all. So being a nationalist, it looks great, but at the same time, it's very difficult to what you are going to produce and sell to China. You can be an intermediary play, like for example, companies like Dixon, what they do. There are certain components which comes from China to India, they process it, they do some value addition, and they again supply it back to China only. So basic raw material, if you look at it, be it pharmaceutical or this electronics play, that is still coming out from China. So that job work kind of a margin is not that great. In US, if you are selling a end product, or in Europe, then the margins and the profitability is high. So all these adjustments are still to happen in a big time because nobody is very sure how this mathematics is going to play out, and that is the reason jumping the gun as to how the weightage and reallocation, because we are looking at history. From historical perspective, it does look like so much money should flow into India, but that is history. That was a different set of calculation which we were looking at. New calculations, how much will come and not come, it's too early to suggest that.
So in this given scenario, like you very clearly said, maybe from a year-on-year basis, Q2 might look good because of the base effect of the last year. What sectors do you think that people should be actively looking at?
So, I mean, the math is very simple. Wherever government of India is a spender, you have to be there. And that is how it has worked for the last 2 years. And going forward in the recent setup, to look at it, it's government who is getting you direct tax benefit, it's government who is getting you indirect tax benefit to boost consumption. Again, somehow inflation has come down because even GST cut is deflationary in nature.
Correct.
It will again pull down the interest rate. So if these things are falling into place, RBI will have no choice but to cut interest rate further. And only elbow trade-off right now is US is not cutting interest rate. The moment they cut, you again get an elbow room to cut
Correct.
interest rate here
Further,
to stabilize your currency, and that has to be taken care of because oil, end of the day, you are paying in dollars. So that too, India is negotiating with Iran and other countries where they are dealing in their local currencies or bargain is happening. But if you look at the entire scheme of things, India has been a story of government spending. IT and pharma was only two phases where there was some kind of a delinkage out there where you are trading with others and getting income. But again, you're back to the same kind of a scenario. I think defense continues to be a sweet spot. It will have its own volatile kind of a session. It will, I mean, prices may go up and down. Some brokerages feeling valuations high or expensive, but structurally, you're sitting on a book to bill ratio of almost 4x. So right now, 1.25 lakh crores is what the total defense,
Please, yeah.
utilization is by expenditure by all the companies listed and listed put together. But the order book is around 4 lakh crores. That is the kind of a scenario you are sitting in. This will continue to do fairly well. End of the day, financials, domestic consumption picks up or defense and infra spending goes up, it will continue to do well. How much is we have to see. Renewable energy sector, the entire power theme, again government is directly or indirectly invested into that. It will continue to pick up, and ancillary industrial suppliers of power projects. So be it power generation or transmission and distribution or in product switch makers, circuit breakers and all, these companies will continue to do fairly well. Infra is another area where government is a spender. So road construction, tunnel, airport, highways, building materials, cement is a part of that. So these are the sectors where I think continuity will be maintained. Other pockets will depend on the cyclicality and how things shape up.
Right. So, from a market cap bias basis, you think the kind of play that we are seeing happening in our economic cycle, do you think it makes prudent sense to play more largish than go small?
I think it's a bottoms up approach right now. One should not be colored by the sector or a market cap. You have to pick up individual stories. And that is what we have seen in the present market. Individual stories have still worked out. Banking is a space, you have one ICICI Bank performing and Axis Bank not performing.
Absolutely.
Same as in the PSU sector, SBI performing, but others not performing. They're just languishing where they are. So it will be a scenario where one has to be company specific, where the projects are there or the order book is fine and execution is happening without any hindrances. I spoke about renewable energy. NTPC Green is one company which we have liked for long. But what happened last year is because of land clearances not coming through, their entire trajectory was getting delayed. So now, which is again started happening, government has given 20,000 odd crores to NTPC, which is a parent company, to fund the renewable project. So wherever the clarity emerges, there it will be fine. But the same color cannot be painted for the entire sector as a basket. So a difficult and tough hard work to be done.
But I think one good thing that I took from you from this discussion is that you have a limited downside.
Yes.
Given that you spoke about the bond yield to the equity yield, and you spoke about how the equity risk premium will play. So you also spoke about a potential upside of around 10% from here if the things play out. So there are positive takeaways in this market as well. So I think limiting downside for us is a much bigger thing than potential upside, because all said and done, there is a lot of retail investment in this bucket, and like you said, it's more heard than really researched. So for their sake, the downside protection seems to be very, very important.
Yeah, but that's definitely very critical, and that's a silver lining to the entire thing. Because end of the day, in equity market, the worst thing you fear about is losing your capital.
Absolutely.
That I don't think is a scenario right now. All the geopolitical issues and everything seems to be settling down, and even the supply chains are back into place. So things are working fine. It's been a bit sluggish, slow and steady kind of a state. But definitely, staying invested in equity is the mantra right now. You have to stay invested. Maybe a time period can be a bit delayed. It can be a bit longer kind of a time period. But eventually, when the run up happens, we have seen how equity rewards you as well. So if something has to go 3x, it may not go, say, in 5 years time frame. It may not go for next 3 years, but next 2 years it will be 3x. And the only point why we say stay invested is we don't know when this upcycle is going to begin.
Correct.
So don't time the market. Spend time in the market is the mantra right now.
So basically, if I have to take this rightly from you, it's a time to keep staggering and keep investing in the markets. Don't stay away from the markets, is what you're saying. Take a calculated and researched look at what you are actually buying, and don't just go by herd.
Yes, definitely.
Yeah. So
Beautifully put up. Yeah.
Thanks, Dharmesh. As
you so
usual, very pleasure talking to you. You are in a position to demystify a lot of stuff very, very simply. And thanks a lot for joining us. This is Sridhar
Thank you
signing
so
off for Trend Talks. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.